Imagine sitting across from a finance manager at a dealership. He slides a printout across the desk. The number at the bottom reads $612 a month. You do the quick math in your head. That is less than your rent went up last year. You sign, relieved. What the printout does not make obvious is the number sitting just above the payment. 84 months, 7 years. Longer than most Americans keep the same job. Longer than the powertrain warranty on the car itself. Longer, in many cases, than the marriage of the couple sitting in the next finance office over. By the time that loan is finally paid off, the vehicle in the driveway will be worth a fraction of what was borrowed to buy it. An 84-month auto loan is being sold to millions of Americans right now as the reasonable answer to an unreasonable car market. It lowers the one number a buyer actually looks at, the monthly payment. It does nothing to lower the price of the car, the interest rate, or the speed at which that car loses value the moment it leaves the lot. It just spreads the cost out long enough that the pain stops registering, month after month until it does not. The average new vehicle in America now costs more than $50,000, a price point that did not exist 5 years ago. Nearly a quarter of new car buyers are now signing loans of 84 months or longer, a record share. Add in everyone financing over the past 6 years, and it is more than a third of the entire new car market. So the real question is not whether these loans exist, it is who actually benefits from them. Because the deeper you look into how an 84-month loan gets built, priced and sold, the clearer it becomes that the answer was never the person signing the paperwork. There was a time when a car loan was designed around a simple piece of math, and that math was not built for the buyer's comfort. It was built around the car itself. For decades, the standard auto loan ran 36 to 60 months. Lenders built it that way on purpose, not out of generosity. A car loses value fast in its first few years, and a lender needs the loan balance to stay below what the car is actually worth every single month in case the buyer stops paying and the car has to be repossessed and resold at auction. A shorter loan keeps the debt ahead of the depreciation curve. That relationship, a loan balance below car value, is the entire foundation the auto lending industry was quietly built on. Keep that in mind, because it is the exact rule the industry is now abandoning in plain sight. Under that older model, a 5-year loan on a reasonably priced car meant the buyer owned real equity within a couple of years. Trade the car in after 3 years, and there was usually money left over, not a bill waiting to be rolled into the next one. The system worked because the length of the loan matched the life of the asset behind it. Nobody needed a 100-month loan, because nobody needed the payment lowered that far. Cars were cheaper, income stretched further, and a 5 or 6 year commitment already felt like the outer edge of what a reasonable household would take on for a depreciating purchase. If you have gotten this far, you are exactly the kind of person this channel is built for. Subscribe because we are about to walk through exactly how this quietly stopped being true, and almost nobody noticed it happening in real time, including the people signing the contracts. Because somewhere along the way, the price of the car stopped cooperating with the math. New vehicle prices did not rise gradually, they spiked. Pandemic-era supply shocks, a global semiconductor shortage, and years of steady inflation pushed the average transaction price for a new car up more than 30% since 2020. In December of 2025, that average crossed $50,000 for the first time in history, according to Kelley Blue Book. Tariff-related cost pressure in early 2026 pushed it higher still. Wages did not rise 30% in that window. Down payments did not grow to match. The average new vehicle monthly payment reached $770 in the first quarter of 2026, according to Experian, up 2.9% from a year earlier. Auto loan originations hit $182.1 billion in that same quarter alone, according to the Federal Reserve Bank of New York, with borrowers under the age of 50 accounting for well over half of that total. The math that used to work, a manageable loan on a fairly priced car, simply stopped balancing on its own. Lenders and dealers had 2 honest options available to them: lower prices, or accept that fewer people could afford a new car at all. They chose neither. Instead, the industry reached for a third lever, one that never touched the price of the car. It touched the length of the loan attached to it. Interest rates were not cooperating either. The Federal Reserve held its benchmark rate at a range of 3.5 to 3.75%, through much of this period, keeping borrowing costs elevated well above where they sat before the pandemic. Higher rates on top of higher prices meant the monthly payment problem was coming from two directions at once, not one. Stretch the term long enough, and almost any price can be made to look affordable on a monthly statement, at least for a while, at least on paper. But something changed the moment that lever stopped being the industry's last resort and became its default answer. In the second quarter of 2026, according to Edmunds, 23.9% of new car buyers signed loans of 84 months or longer. That is a record, and it keeps climbing every quarter. A decade earlier, the share of buyers stretching past 72 months sat around 27% in total. Now more than a third of all new car financing, 36.5%, runs 73 months or longer. Loans between 60 and 75 months, once the overwhelming centre of the market, made up just 67.4% of new vehicle financing in early 2025, down from 77.7% only 6 years earlier, according to Edmunds. The middle of the market is not holding. It is being pulled apart from both ends. This did not stay confined to buyers with weak credit trying to squeeze into a car they could not otherwise afford. David Kelleher, a Pennsylvania dealership operator, told the Wall Street Journal, "We don't have $300 monthly payments any longer in new vehicles." Some credit unions, including LOC Credit Union and Americo Federal Credit Union, have begun advertising auto loans stretching to 100 months, more than 8 years of payments attached to an asset that starts losing value the moment it leaves the dealership lot. Eric Croak, president of Croak Capital, put it bluntly when asked about loans of that length. "I don't think it's necessary to sugarcoat," he said. "A car financed over 8 years will likely lose roughly a fifth of its value before the buyer even reaches the second oil change, let alone the final payment on the contract." Most car shoppers are what the finance industry privately calls payment buyers. They walk in asking one question: what will this cost me a month? Rather than asking what the car actually costs in total, or what rate they are being charged. That single habit is what makes stretching the term such an effective lever. It answers the only question most buyers are actually asking. The industry did not solve the affordability problem sitting underneath rising prices. It hid that problem inside a longer piece of paper. Here is what that hidden cost actually looks like once you put real numbers against it. Using Experian's average new car interest rate of 6.37% on a $57,500 vehicle with an $11,500 down payment, the monthly payment on an 84-month loan runs about 40% lower than the same loan spread over 48 months. That sounds like a win. It is not, for a few reasons stacked on top of each other. Lenders do not offer that longer term out of generosity either. A longer loan exposes a lender to more years of risk that the borrower loses a job, gets sick, or simply defaults. So longer terms typically carry a higher interest rate than shorter ones on the same borrower profile. The buyer often pays a higher rate on top of paying it for longer, a double cost most people never see broken out on the page. Stretch that same loan out to 84 months, and the buyer pays an additional $4,905 in interest over the life of the loan, according to Experian's own comparison of the two terms. The lower monthly number did not save anyone money. It simply moved the cost off the monthly statement and buried it inside years of extra payments. The buyer will barely register, one small bill at a time, long after the excitement of the purchase has worn off. And every one of those extra months is a month where the loan balance stays high, while the car underneath it keeps losing value on schedule, whether the person making the payment is paying attention to that fact or not. That imbalance alone would already be a bad trade for the average buyer. It is not the worst part of this story. Remember the rule from earlier, the one about keeping the loan balance below the car's actual value at every point in the contract. An 84-month loan breaks that rule almost by design, for years at a stretch, for a huge share of buyers. The results are already visible in the data. In the first quarter of 2026, 30.9% of all trade-ins toward a new vehicle carried negative equity, the highest share for any quarter since 2021, according to Edmunds. The average amount owed above the car's actual value hit $7,183, up 42% in just 5 years. Nearly 1 in 10 of those underwater trade-ins carried more than $15,000 in rolled over debt. Buyers rolling that balance into a new loan financed an average of $55,970, with monthly payments reaching $932, a record high and well above the industry average. Even Drury, an analyst at Edmunds, has pointed to a simple explanation. Loans written when prices were inflated are now aging into a market where values have normalized, so the gap between what people owe and what their cars are worth is becoming impossible to ignore. Here is the detail that closes the loop entirely. Of buyers who are already underwater and financing again, 90.2% are extending their new loan to 72 months or longer, and 43% are signing another 84-month term according to Edmunds. The long loan creates the negative equity in the first place, then becomes the exact tool buyers reach for to bury that same debt inside the next car. Joseph Yoon, an Edmunds consumer insights analyst, put the real story plainly. "It's the amount underwater that is the real and troubling story," he said. "That cycle alone would be damaging enough on its own, but it gets worse. A longer loan is not only more expensive in total interest, it is also easier to hide things inside of quietly at the point of sale." Dealership finance offices have a well-documented practice called payment packing, where extended warranties, service contracts, and other add-ons get folded into the monthly payment instead of being itemized separately on the contract. On a 60-month loan, adding a couple of $1,000s in extra products barely moves the payment, maybe $30 a month. Stretch that same trick across 84 months, and thousands more in add-ons disappear into a payment that still looks small enough to sign without a second thought. Longer terms lower the visible number on the page, and in doing so make it far easier to load additional profit into that number without the buyer noticing the difference. One add-on in particular has gone from optional to nearly mandatory because of the very problem long loans create. Because so many buyers now carry negative equity for years, at a stretch, gap insurance, which covers the difference between what is owed and what an insurer will pay out after a total loss, has become something dealers actively push on almost every long-term loan they write. Meanwhile, the loans themselves rarely stay with the lender who originated them. They get bundled and sold to investors as securities, and demand for bonds backed by subprime auto loans has stayed remarkably steady, even as delinquencies climb toward record highs, according to industry reporting. Much of the risk on these loans is not even sitting with the bank that wrote the original contract. The lender collects the fees and the interest spread up front, then quietly passes the long-term exposure downstream to someone else entirely. A single extended warranty can cost a dealer somewhere close to $1,000 to buy and get sold to a customer for 2 to 4 times that amount. Folded into an 84-month payment, that markup becomes almost invisible. The math was never designed to protect the person signing at the bottom of the contract. The consequences are no longer theoretical. They're already showing up in the numbers, and every quarter they get worse. Subprime auto loan delinquencies hit 6.8% in early 2026, according to Fitch Ratings. That is the highest rate recorded in 32 years. It is worse than anything seen during the Great Recession. Vehicle repossessions surged past 1.73 million last year. That is the highest total since 2009. Subprime borrowers hold only 17% of all active auto loan accounts. They now account for nearly 2/3 of every delinquent auto loan in the country, according to the Federal Reserve Bank of Philadelphia. 90-day delinquencies across the entire market, not just subprime, reached 5.6% in the first quarter of 2026, according to the New York Fed. That is up more than 12% from a year earlier, and well above the long-term historical average of 3.59%. In late 2025, Tricolor Holdings, a major subprime auto lender, collapsed into bankruptcy amid allegations of fraud. Months later, America's Car-Mart was forced into an emergency workout with its own lenders just to stay operating. In February of 2026, Senator Elizabeth Warren opened a formal congressional investigation into auto lenders and repossession companies, citing the scale of the crisis unfolding across the industry. Overall auto loan debt in America now sits above $1.67 trillion, spread across 108 million open accounts nationwide. Prime borrowers, the ones with strong credit, are still paying on time. The distress is not evenly spread. It is concentrated almost entirely among the households who could least afford a bad outcome in the first place. And those are disproportionately the same households leaning hardest on the longest loan terms to get approved at all. None of that debt disappeared. It got stretched, repackaged, and sold 3 times over, and the people still carrying it are the ones now falling behind, one repossession at a time. So what does an 84-month auto loan actually accomplish for the person signing it? It comes down to 3 things. First, it lowers the monthly payment just enough to make an overpriced car look affordable, without lowering the actual price of anything the buyer is paying for. Second, it guarantees the lender collects more total interest over the life of the loan, while keeping the loan balance above the car's falling value for years longer than any responsible underwriting model would have once permitted. Third, it creates the exact conditions, negative equity and hidden add-ons, that generate the industry's next round of profit, from gap insurance policies to repackaged securities sold to investors who are nowhere near the room when a buyer actually signs. An 84-month auto loan is not a mistake the industry stumbled into by accident. It is a solution to a problem the industry itself created, and it was never really designed to solve that problem for the person making the payments every single month for the next 7 years. The lender gets its interest either way. The dealer gets its markup either way. The only party whose outcome actually depends on whether the car holds up, the job stays steady, and the payments keep landing on time is the one who signed for it. Everyone else in that transaction has already been paid, or has already sold the risk to somebody else down the chain. The next time a finance manager slides a printout across the desk with a small friendly monthly number at the bottom, the number worth asking about is not that one. It is the one sitting quietly above it. If this is the first time you have actually seen the math laid out like this, you already understand why this channel exists. Subscribe.